Okay, so my name is Thomas Ash. This is a short presentation that I was supposed to give during UCLA Anderson Forecast's December meeting on banking and finance. Unfortunately, an unanticipated fire alarm stole my time. So instead, we're providing this video online for anyone that's interested. So this is titled Green Lending Cycles. So why even talk about this at all? Well, climate change is happening. And some have argued that the pace of political intervention on climate change has been too slow. And so an avenue that has been suggested that may help improve that speed is green finance. So that's why it's worth talking about this. So just a quick note, which is that green finance includes a pretty terrifying array of different acronyms, measurements, subsectors. There's a center called the Center for Impact at UCLA Anderson that does some work on different ESG measures. And the panel's discussion during the forecast meeting was about this changing nature of the financial sector in general. But overall, one of the takeaways from this presentation is that you really need to go through and look at each individual segment of the green finance industry separately and analyze that on questions such as, does this actually improve environmental performance and other questions like that? So I'm going to focus here just on this one subsegment called corporate green bonds. And so to fix ideas, a corporate bond is when a company wishes to borrow money to, I don't know, increase its capacity or to finance a transition in its business practices. And so in which case it issues a corporate bond, which gives it those funds, and investors are willing to purchase these bonds because they return the payment at the end of the maturity date. And in addition, they pay these fixed interest payments on a regular basis, usually yearly. And so the addition of green here just means that these have been designated as providing green funding. For a green project, it might be a solar company increasing their capacity and their output, or it might be Google investing to enact a green transition. So that's kind of what we're talking about here. There is ways of collecting this data. So what I'm going to be talking about here is this universe of these corporate green bonds from 2013 to the present, which is collected from Bloomberg. Really, before 2013, these corporate green bonds didn't exist. I quickly just have a couple of summary statistics there about their average maturity. They're pretty global, but mostly in the US and Europe. They tend to be reasonably well rated. And then in addition to that, I'm going to collect for each green bond, a matched bond matched on a range of criteria like issuer, issue date, maturity, so that I can compare that with the green bond and come up with comparisons about the actual impact of green bonds. So here I just also note that this other paper, there's other literature and other academic research. I'm not the first to look at this. One interesting paper is this paper by Caroline Flammer in the Journal of Financial Economics called Corporate Green Bonds. And in that paper, one of her conclusions is that companies issuing these green bonds do tend to improve their environmental performance over a period of 3 or 4 years. But the other thing that she finds is that there's no evidence of a discount when issuing corporate green bonds. And so this means that we would expect that if you issue a corporate green bond, you have access to a larger pool of financing because there are quite a few investors that want to get involved in green investment. And as a result, you'd be able to obtain a cheaper interest rate on these corporate green bonds. In this paper, Caroline Flammer finds that that's not true. And so one thing that I investigate in this work that I'm going to show in these next few slides is whether this discount exists, because there are other studies in the literature that actually find that there is a discount. And so there's some dispute in the literature of whether this kind of a discount exists. So first, just to show you the total issuance of these corporate green bonds over time. So the x-axis here just shows time from 2013 up to more or less the present day. And this chart just shows total monthly issuance of these corporate green bonds. And you can see that it really rises a lot over time, and it's really expanded a lot up to this kind of peak around in 2021. It's fallen off a little bit since then. And this more recent fall off, I've checked more recent data. This really goes up to kind of March of 2023. And actually it kind of recovers some of that ground. So it's not, a permanent fall. But this essentially is an asset class that has grown rapidly over the past 10 years or so. So as I mentioned, one of the key questions here is whether this discount exists. And this is important because if firms feel that there is a pricing discount, that's a good incentive for firms to engage in these green investment projects because they can obtain cheaper financing for engaging in them. And so this examination of this cost of financing, or the yield, so the yield for a bond is just the interest payments over the price. So it's really just capturing how much it costs these companies to finance these projects. So this is part of some joint work I have with Matthew Kahn at the University of Southern California, who has done quite a lot of work on climate change, has a bunch of books on the topic. And so you see here in this chart, first of all, just the right-hand axis is just showing the Fed funds rate. And this is just this dashed gray line at the top, which is just there for reference. And just note that the zero is not at the bottom there, it's just higher up so that it's out of the way of the other chart. The x-axis again is over time, so we can see how this evolves over the past 10 years or so. And then the left-hand axis is referring to the kind of main black line in the chart, which is just the yield on these corporate green bonds. And so for each date, so for each month that I have here, for example, 2013 month 1, there is a distribution of corporate green bonds. So say there could be 20 green bonds for that time period or more. And so what the black line charts is the median bonds yield for that time period. And then I also show the 75th and the 25th percentile bonds for comparison to understand the dispersion. And so you can see that these yields move up and down over time. They're kind of cyclical. And you can see that some of that cycle appears to be related to the Fed funds rate. They kind of align, but it's not all like that. And so one question that's important to understand whether these discounts exist is, what are the factors determining these cycles? And so, like I said, the literature has some dispute about whether these discounts exist. One argument that I'm putting forward, and we put forward in this work, is that they differ depending on the time period that you look at. And so if you look at some time periods, you'll find that the discount does exist. You look at others, you'll find it doesn't exist. And that depends on some factors that we look into as part of this work. And then I'll just show in a couple of slides briefly. So to really understand this and to compare green bonds to normal bonds, we have to compare it to this set of matched bonds that I mentioned earlier. And so here now I add in this dashed black line, which just shows the overall set of matched bonds, their yield, and how that evolves over time. So if there is a discount for these green corporate bonds, then that would be seen with the black line being underneath the dashed line. So then they would provide cheaper financing. And you can see that varies quite a lot over this period. It's not always true that there's a discount. In some periods, it appears to be the other way around, in fact. Part of the reason for that is that in this chart, I'm really just looking at the overall set of each of these. This is not really the comparison of each individual bond to a like-for-like bond. And so that's really the purpose of doing a full statistical analysis, to be able to do that real comparison. So what happens if we do that real comparison and do that statistical analysis? Well, what we found is that during certain periods, there does appear to be a discount. That is, it is cheaper to engage in this green lending. And two of the important factors that we look into that drive whether this discount exists are the economic cycle. So as I mentioned, the evolution of the Fed funds rate over time is part of that. Our work looks at this and essentially shows that for moderate interest rate or Fed fund rate increases, there's around a 20 basis point decrease in the discount of the green corporate bonds relative to the non-green bonds. And the other important factor that we highlight is climate awareness cycles. So that is that during periods when people are very engaged in the climate and the issue of climate change, that affects this discount. And in particular, it means that more funds are available during that time, and this discount increases. So the gap between the financing rate on green corporate bonds is lower than the financing rate on non-green bonds. We find it's about 15 basis points during moderate climate events. One thing to note here, though, is that there are non-moderate events, so there are more extreme events, and there are quite a few of those, so the effect could be greater, and also that these are just causal changes that I'm looking at here, but if you extrapolate these numbers to other events that increase climate awareness, that means that these effects could be broader too. So that's really all I wanted to say today. Just some quick takeaways. One is that, as I mentioned, this corporate green bond market has increased rapidly. And for these corporate green bonds, these are linked to real environmental improvements, as seen in this paper that I cited earlier. But this really highlights that it's very important to look at each individual area of green finance individually to understand if it has these desired characteristics. Just because this is true for green corporate bonds does not mean it's true for other types of green investing. And then finally, the discount that exists appears to be dynamically evolving, and it varies according to these two factors that I highlighted today: climate awareness and the economic cycle. Okay, thank you for listening.